Hi class. Today we're gonna talk about the very last chapter of our class, chapter 12, statement of cash flows. All right, and this is gonna be our last chapters. And however, this chapter is not covered in the final comprehensive exam, which only covers the first 11 chapters. All right. But this will be in your the quiz 3. All right. So let's talk about chapter 12. All right, chapter 12, statement of cash flows. And before we start, and there are several questions we need to ask, right? So first of all, why companies have to have a report for cash, right? So what's the purpose of having this statement of cash flows? And what does that do? What purpose that serves for a company, right? So if we have a statement of cash flows, and then from the cash flow statement, what we can see here are some questions that first, for example, that how does a company obtain this cash, right? And where does the company spend its cash? And what explains the change in cash balance? So basically, these three questions is, okay, where do we earn those cash? Okay, so companies, cash is the most important thing for, well, one of the most important thing for companies' sustainability. Okay, so how companies can survive, all right? So if we are lack of cash for business operations, and more than likely we're going to run into bankruptcy. Okay, so recently that you see Neiman Marcus, they declared bankruptcy, and it's because really they are not able to pay off their employees, and they're not able to pay off their short-term debt. It's not about whether it's not about they are losing money per se, even though they are making profits, but their cash balance doesn't really look good, and that will ring the bell, and that will cause some problems, and it's a serious problem. All right, so first we can see where the money come from, right? And usually it's from their business operations, right? Their revenue earnings. And where do we spend cash? Okay, so how much debt you need to pay off, and how much expenses you need to pay, cash expense you need to pay off, and what explain the change in cash balance, whether cash balance increase or decrease. Okay, what activities cause that change happens. All right. So additional to these three questions, there are some other questions that statement of cash flows can help out to answer. Okay, so how did the business fund its operations? Okay, if we have enough cash generated from our business operations, then we don't need to worry about funding cash from financial institutions, right? But if it's not the truth, then we're gonna find some other ways to fund our cash, right? So another is, does the business have sufficient cash to pay off its debts as they mature? Okay, so this is one of the questions that tie back to business bankruptcy. And did the business make any dividends payments? Okay, if they do, how much they're gonna pay, and if they have enough cash to pay off those dividends, right? And did the business borrow any funds or repay any loans? Okay, so basically it's tied to here. All right. So identify cash flows arising from operating, investing, and financing activities. Remember in chapter 1, when we talk about business operations, we talk about 3 different activities. First is operating activities, second is investing activities, and the third is financing activities. And for operating activities, I think it's pretty intuitive, right? But in terms of investing activities and financing activities, and there are some confusions between these two terms and between these two activities for students' understanding, all right? So then we need to pay attention, or at least we need to pay a relatively more attention to investing and financing activities. Sometimes you see that one activities you really think that it's investing activities, but it turns out is to be financing activities. And what the reason is for that, we're going to talk about that later. Okay. All right. So first of all, what is cash, right? What is cash? And in terms of the definition for cash, there's a little bit difference from the general definition. So in general, we talk about currency, right? Those U.S. dollars, Chinese currencies, Japanese yen, European euros, Okay, and those are currencies, right? And besides currencies, what else we consider as cash? Those are checking and saving accounts, and basically it's not something that you carry in your pocket, but it's sitting in your bank account, and you can withdraw them anytime you want, right? So and spend it somewhere else, and that is also considered cash. And cash equivalents also is considered cash. What are cash equivalents? Cash equivalents are those highly liquid short-term investments, which means those short-term investments will be matured within 3 months, right? So short-term current assets, those are assets will be turned into cash or be used up within 12 months, right? 12 months, not 12 years. However, we break it down into more detailed level. If something that will be used up or turned into cash within 3 months, we call it cash equivalent. Otherwise, we call it current assets. Remember that? Okay, so cash equivalents also is considered cash as cash. All right. So those are the 3 major elements of cash category. All right. So business activities and cash flow continued. And the statement of cash flow focuses attention on operating activities, that is cash received or cash paid for their day-to-day activities like sales, revenues, which is cash received, and cash paid is to their employee salaries, sales commissions, utilities, insurance, property taxes. All these are operating activities. And investing activities are those cash paid or received from buying or selling long-term assets. Okay, you are buying all these things. You pay cash for acquiring some things. The purpose for that is to expanding your business in the future, and those are investing. The investing is now the general term that you invest money on the financial market, which is different from the investing term. The investing here we use. Okay, investing only is focused on the business expanding, okay, business growth, okay. And financing is cash received and paid for exchange with lenders and stockholders, which is investors' contributions into the company, which is tied back to your investment on the financial market. All right, so that is called financing activity. If you are buying stock on the market and become this holder, and first of all, company has to issue stock, right? And that process, issuing stock process, company consider that financing activities. Okay, and other than that, if companies running short on cash, they are borrowing money from lenders and some other credit agencies, and those activities also is called financing activities. Okay, so the big difference here between investing activities and financing activity is that investing activities here for business term, it is only focused on business expanding, business growth. Okay, it is not for business return in a financial on a financial market. Okay, it is not quite right. Okay, and that financing activities is where a company running out of cash or resources is gonna ask investors or stockholders or owners, whatever you call it, and the lenders to supply for more cash. All right. So those are the general 3 activities, and we're gonna break down our statement of cash flows by these 3 different activities. Okay, this is very, very important. Okay, this is very important. All right, so here is Under Armour financial statement of cash flows for the year end 2016. Okay, and we start with the section called operating activities. Okay, and this is an indirect step for preparing statement of cash flows. Okay, and we have for the operating activities, the title is cash flows from operating activities, and it start with net income. Okay, net income and adjustments to reconcile net income to net cash provided by operating activities. Okay, depreciation, change in current assets, current liabilities, which is the subtitle for all these accounts, which are accounts receivable, inventory, prepaid expense, accounts payable, accrued liabilities. And you will find out, or probably some of you already find out, that any of these activities or any of these items we listed under operating activities are really non-cash activities, right? They are non-cash activities. And the idea here, or the theory behind this, is because net income, which is derived from revenue minus expense equals net income, right? And here the theory, the reason is that because when we prepare income statements, when we prepare this income statement, we have a portion of revenue which is non-cash, right? And which is sales on credit. Remember that? Okay. And we have accounts receivable, right? And here are some expenses also are non-cash expenses. For example, depreciation, amortization, and some other things, right? So then we arrived at this net income, which also that has a non-cash portion and cash portion, right? So now we have to, and for this indirect step of preparing statement of cash flows, we start with net income. That way, anything here is including cash and non-cash numbers, and through this non-cash activity adjustments, we can adjust this non-cash net figure down back to its real cash number. Okay, so that is the cash change or cash increase or cash decrease from the operating activities only. All right. And then we have the subtotal line for operating activities is net cash provided or used by operating activities. It is a positive number, which means that we have a cash surplus, right? Then it's net cash provided. If it's in the parentheses, like the number here, then that means it's cash being used by operating activities. Okay, so we used more, right? And then next section is cash flow from investing activities, and here we have purchase of equipment, purchase of intangible assets, and then net cash activities is negative number. Okay, put in parentheses. We are spending more cash in this activity, right? From this activity, and then the last one is cash flow from financing activities. Okay, so first operating activities, and then second investing activities, and the third financing activities, and then all these are from financing activities. You see this additional long-term notes that we issue notes to fund money, and payments on long-term notes, including principals and interest, right? We paid back for those long-term notes, and that is due to the money borrowed through long-term notes. Then also it belongs to financing activities, and proceeds from stock issuance, that is cash received from stock issuance, right? And that also, that is financing activities. Cash dividends paid, the same thing. Okay, and then we have net cash paid, provided or used in financing activities, and net increase or decrease in cash and cash equivalents. Okay, if it's positive number, is cash increased. Okay, like 120 here. If it's in the parentheses, that is cash balance decrease. We used more cash this year than last year. Okay, and we used more cash this year than we earned cash. Okay, so then cash equivalents at the beginning period, which is 130, and then add 120 cash that increased through the three activities here over the year. Our ending cash balance is $250. All right, so this is the This is the cash statement of cash flows for a public company. All right, and in general, you're gonna have exactly the same, or let's say 99% of 99.99% time, you're gonna see very much similar the form of statement of cash flows from across those public companies. All right. All right. So operating activities. Now we're going to talk about these three different activities in detail. Okay, so operating activities are cash flow and outflow directly related to revenue and expenses. Okay, and examples: cash inflows, collecting from customers, receiving dividends. Okay, so this is operating activities, but paying dividends, that is financing activities. All right, financing activities. Why is that? Because paying dividends is because we as the company are issuing stock to our stockholders, right? But we are receiving dividends. That is because we invest, we purchase some share of stock from other companies. That makes sense? Okay, so we are purchasing stock from other companies, and some students probably ask, then why we investing stock from in other companies is in the operating activities? The reason is in the net income statement. When we prepare this income statement, we have net income, and all the items here we have revenue, and then have income from operations, and have some other income, right? And other income that includes interest income, dividends income, and per GAAP, all these non-operation or operating activities earnings also has to be reported under on the income statements. So that is why receiving dividends also is considered. It has to be reported as operating activities cash inflow. All right. And receiving interest, okay, and cash outflows, we purchase services like we're paying utilities and goods for resale, or we purchase supplies, right, and then paying salaries, wages, income taxes, and interest. Okay, anything that you're paying out of pocket cash for your business operations, that is cash outflows for cash operating activities. All right. And then investing activities, those are relating to purchase and disposal of long-term assets or investments, okay? So three big common investment cash flows: buying and selling long-term investments. Okay, what is long-term investments? That is your equipment, machineries, and your copyrights, and so on and so forth. Okay, so why it's called long-term called investments? Because you are investing in these resources and aiming for business growth in the future, right? So those are long-term investments. And buying and selling long-term assets. Okay, land building equipment. Okay, and similar thing. Okay, those number one, number two are similar thing. And third, loaning cash or collecting principals on long-term note receivables. Okay, note receivables, and that is another investments. Okay, and financing activities, cash flows from financing activities include exchange cash for stockholders and cash exchange for with lenders. Okay, so you are borrowing money or you are issuing stock for investors' contributions. Okay, and then paying dividends here, of course, that is financing activities. All right, and so this is an example. You are welcome to look at this and work on this. Which out of these 10 activities, which are operating activities, which are investing activities, which are financing activities, and the solution is right here. All right. So report cash flow from operating activities using the indirect method, which is a common method. Okay, it's a very common method. All right, there are two methods. So one is direct method, one is indirect methods. Okay, and most of the companies are using indirect methods. Okay, and cash flows. Okay, so here is the formula. Okay, so here is the formula for us to transform net income all the way into cash flows from operating activities. Okay, under using indirect method. And first, we have to add back non-cash expenses. Okay, so because when we calculate net income, revenue minus expense equals net income, and we already subtract non-cash expense and cash expense from revenue to get net income, right? So then, even though those are expenses, but they are not cash related expenses, really it doesn't cause our doesn't really change our cash balance, right? So we need to add all these non-cash expenses back. And second is we're gonna analysis the change in non-cash current assets, current liabilities. Okay, so if we have non-cash assets like accounts receivables and current liabilities, accounts payables, okay, those things, okay, we are not consider we have to subtract increase in accounts receivable, and because accounts receivable is part of our credit sales, right? Credit sales. And here is why I'm keep telling you that every chapter is cumulative. Okay, because right here we are using the overall concepts of the whole financial accounting theory here, or knowledge here to apply on the financial statements, right? And accounts payable, okay, accounts payable really is we owe something, but really it's not non-cash outflows, right? So, and we need to add back non-cash accounts payable liabilities increase back, and subtract non-cash assets increase from net income. Okay, and third one, we're gonna add losses and or minus gains. Okay, or let's say minus losses and or minus gains. Okay, add losses or minus gains. Okay, and or. Okay, and then we're gonna get, because losses and gains, they are the calculation before net income as well. Okay, as well. And you see, I don't really see this on the income statements. That is correct, because we are really learning a simplified form of income statement. Okay, so but these things are before net income calculation. Okay, and before net income line for that. Okay. And those losses and gains are non-cash activities per se. And why is that? Go back to your disposal of equipment, and you'll see we make journal entries, and then involves losses and gains, and you see that is really not cash. Okay. All right. So here is the formula for you to deal with the change in account balance during the year. Okay, so current assets, if it's increase, we are going to subtract from net income. Okay, if it's current liabilities increase, we're going to add to net income. If it's decrease current assets, we're going to add back to income, and then current liabilities decrease, we're going to subtract from net income. Okay, and this is only used for indirect methods. All right. Report cash flows from investing activities and financing activities. Okay, and so here, figure out what our net income is. Okay, what are net financing activities? What are expanding financing activities and investment activities? Okay, so here is a practice problems. Okay. And here are those information for you to deal with, whether those are investing activities or financing activities. Okay. Go back to look at it by yourself. You have all the solutions, all right, or answers. Okay. And you add back. Okay. And non-cash investing and financing activities, what do we do with that? Okay, so when we have all those things and non-cash activities and require the supplemental information, cash paid for taxes and interest and significant non-cash investments and those things, and we have to disclose them as well. All right, but you don't have to worry about this in our class, okay? Because this is not going to be on the final, and during the quiz, I will just test on some basic knowledge about this chapter, okay? Interpret cash flows from operating investments and investing and financing activities. So operating cash flows must be positive over the long run for a company to be successful. Okay, so the fundamental reason here is that we don't have enough cash generated from operating activities. There are some problem with that, and the problem with that, first problem with that is that we are not generating enough revenue. Okay, not enough. Which means our business is not popular, it's not attractive to the customers, okay? And second reason is that if we're not having all those enough revenue, okay, we are not gonna have enough cash from operating activities, and then we have to keep generate cash inflows from the other activity, which is investing and financing. That means you are going to issuing more stock, borrowing more money, or selling more equipment, right? And this causes problems that you're gonna lose reputation or confidence from your investors, your owners, and second of all, you're gonna lose reputations to those creditors. They're not gonna issue lend more money to you, or even though they do, they're probably gonna charge you a much higher interest rate, which you're gonna have a higher cost of using their money, okay? And then the final problem you're gonna end up with is gonna be bankruptcy, okay? Bankruptcy, all right? So then your company is gonna be dead. All right, an upward trend in operating cash flows over time indicates growth and efficient operations, okay? You see the cash flows from operating activities in this decreasing trend. That tells something. Okay, that tells something. All right. Investing cash flows. Healthy companies tend to show negative cash flows in the investing activity section because they have to buy those assets, resources to keep company growing, right? And if you're selling those equipments, let's say you're selling your office buildings, you're selling your manufacturing machineries, you're selling your sales stores, even though they're gonna have some cash inflows, but it's only a short-term period of time, okay? It's gonna be temporary, it's gonna be lasting forever, right? And that's, you see a negative cash flows from investing activities. Usually that is a good signal, okay? That is usually a good signal, all right? But if you're seeing a positive, constantly positive number from investing activities, that is something you need to pay attention to, because this company is not going to be in the market forever, okay, or for any longer period. All right, be cautious over a positive total cash inflows. All right, and then financing activity. It's not possible to evaluate financing cash flows by simply determining whether they are positive or negative on this overall basis, because it really depends on companies, strategies and goals. If companies that's deciding to speed up their expanding process, probably they're gonna end up with some positive numbers. And if you're having so much cash, then there's no growth opportunities for the companies just during their business cycle, okay, during their mature stage or fading stage, okay. They just keep their operating revenues at the similar level, okay, and then they generated sufficient cash, probably gonna pay it off to their lenders or owners. Okay, and then you're gonna see a negative number. Okay, if a company is a startup company, okay, or company is in the expanding process, you're probably gonna see a positive number from the financing cash flow section. All right. Okay, report and interpret cash flows from operating activities using the direct method. Okay, so only difference between direct method and indirect method for cash flow, stream of cash flow preparation is on the operating activities section. Okay, provide more detailed information, identify cash inflows and outflows relationship, and prepare adjustments accrual basis to accounting and investing and finance sections for the two similar identical. Okay, and here you see that is still indirect method, and now it is direct method. Okay, direct method, cash collected from customers, cash paid to supplies, and cash just all. Direct method, we deal with all cash activities from operating activities. And indirect method, we are only dealing with those indirect non-cash activities, which is the opposite. Okay, which is the opposite. Okay, and why we are not using direct method? Because that doesn't tell too much information. Okay, it doesn't really tell the detailed information about company's performance, which has to be known by or disclosed to those investors on the market. Okay. Alright, so much for chapter 12. Alright, so we don't have any calculation problems for chapter 12 in quiz 3. Okay, so you don't worry about those calculations. But the key here for chapter 12 is you have to understand the basic concept. What is statement of cash flow and what purpose we use statement of cash flows for, and how do we analyze that. Okay, you don't have to calculate the statement of cash flows yourself by yourself. Alright, so if you have any questions, again, send me email, stop by during office hours, or post your questions on the discussion board. Alright, and we're almost done, so good luck with everything, and stay healthy and strong, and be careful with the virus. Alright, bye.